I'm Brooks Frederick, Principal Director, Investment Solutions Strategy here at Envestnet PMC, and I'm excited to provide you our update on what we have been observing in terms of active passive trends. As an asset manager that sits inside the walls of one of the industry's largest wealth management platforms, we believe we have a viewpoint to observe investment trends at both the broader industry as well as from the advisor's level. Most are aware of the trend of the outflows from active funds over the past few years, while passive funds have experienced consistent inflows. However, these broader industry trends don't quite align with what we see here on the Envestnet platform. Over the past 2 years, we see advisors' continued appetite for active funds, but our main takeaway from these insights is that advisors tend to prefer blending both active and passive investment strategies. The data in this quarterly update here provides us a quick, high-level glance at how active managers as a whole have fared against representative asset class benchmarks. Here at Envestnet PMC, we have a longer-term methodical research that serves as our guide to our active versus passive decisions. We like to remind clients that active management is cyclical, and when and if active management starts to outperform, this usually isn't a wave across all asset classes at once. With the exception of active large cap value managers, the larger market cap segments struggled to outperform during the second quarter as well as over the last 12 months. The continued market concentration has made it a challenging market environment for most active equity managers over the past year, as a majority of returns have been driven by a handful of stocks. This has been especially challenging in the tech-heavy large cap growth asset class. Small cap equities were a bright spot during the quarter as the average small cap active manager outperformed across core and growth styles. Small cap managers have been pulling their weight, having outperformed across all styles over the past year. Outside the US, the roles were reversed from the first quarter as international developed active managers made up some ground against passive peers during the quarter, while emerging market managers gave back some of their lead. From our conversations with active managers, most expect to see a broadening out of market breadth for the remainder of 2024, which can lead for more opportunity for active managers. Bond markets ended the quarter in positive territory as investors and the Fed gained confidence that inflation was improving. This lowered yields and added some price appreciation to fixed income funds during the quarter. We saw outperformance across all major core fixed income asset classes during the quarter, which has added to the relative outperformance measures over the past 12 months. Bond yields were quite volatile in 2023, and with the expected interest rate cuts in 2024, most of our active managers we engage with expect continued chop until there is more clarity around the economic backdrop and interest rate policy. We believe this provides an opportunity for active fixed income managers as they have the flexibility to shift their portfolios given the dynamic nature of fixed income markets. Although not notable asset classes in most investor portfolios, we like to highlight some key diversifying asset classes and how active management has fared in these as well. Given the various market dynamics, it's proven a bit difficult for active managers to outperform in these diversifying asset classes over the short term. Envestnet PMC is an industry pioneer in blending the two opposing investment styles of active and passive management together. Active-passive investing is in our DNA. We have been implementing this investment approach within our own portfolios and through our advisor consulting services for nearly 20 years. I want to thank you for listening to our Q2 update on Active Passive, and please be on the lookout for our update next quarter.